Welcome to the Energy Desk, a weekly series from Mobius Risk Group analyzing the macro and fundamental trends shaping global energy markets. To take a closer look at any topics discussed on today's episode, head over to our research archive at research.mobiusriskgroup.com. Let's dive in. Zane, we're sitting here on February 28th, and we've got some crude-centric topics to discuss. How's it going in your world?
Pretty good. Ready to start, ready to talk about all things crude while we are still going nowhere in terms of the price of crude.
Yeah, a lot of conflicting information for sure. I think the big question right now for a lot of folks in the market is what's going to happen? What's the downstream consequence of President Trump's commentary this week? Decided to revoke Chevron's special license to operate in Venezuela, which was granted in November of 2022 by the Biden administration. And then on the other side, we have the reaffirming of tariffs on Canada and Mexico beginning Tuesday, March 4th. And just kind of a quick recap on that was 10% on Canadian energy. And I believe it was, 25% on everything else?
That is correct. And supposedly 25% on all things Mexican. Man, those avocados are going to get expensive again, darn it.
Yeah, and so we have a few different things going on that I think are pretty impactful for North America / U.S. refiners in particular. And I think maybe we can start with the Venezuela situation. So I'll kind of give some background and then we can dig into the details. But Chevron special license, they're producing between 250,000 barrels per day is the estimate. And total Venezuelan production, again, conflicting estimates, which we can talk about, somewhere between 860 to 1 million barrels per day in January. That 1.03 was the first month that they've had over 1 million barrels per day on average since June of 2019, if that is their actual production. That 1.03 would be about 340,000 barrels per day higher since that special license was granted to Chevron in November of 2022. You know, we can give a little background on the sanctions and election stuff if that's worth it. What do you think?
You know, I think the take on Venezuela, I think a couple important points. You know, in theory, a couple 100,000 barrels is impacted by the revocation of this special license. And then when you go back to the point you made earlier about the range of reported numbers for January production, it's about 200,000 barrels a day wide. You know, I guess really, is it relevant? Does it matter? In the grand scheme of things, with all things we will talk about, global crude supply, no, because of all of the sideline to OPEC barrels. Is it directionally important for some read through on what to expect on this maximum pressure on Iran, which I'm sure we'll come to a bit later? Yes, it does matter. You know, I think the other key contextual point here is to really appreciate where Venezuelan production was, call it pre-2020, as we went from, you know, in the Trump's first administration, you know, Venezuelan output was over 2 million barrels a day, steadily plummeted and leveled off around 700,000 barrels a day. So that was a big impact in the Trump round one. And you got to exclude the dips down below 500,000 barrels a day, as you have to do with any country around the world that was having some pressure applied to it by the U.S. from 2020, because that was a different animal.
Everybody was affected.
$20 per barrel oil will impact everybody in the world that makes oil. So could we go from, you know, whether it's 800 or, you know, 1 million, could we go from there back down to, let's just say 700,000 barrels a day, you know, again, about where it leveled off, 700, 750, certainly. Would, you know, going from 1 million to 700,000 be some paradigm shift for the global oil market? Absolutely not. In some ways, you could just look in the same little ballpark in a place where you could fuel up your boat and drive around to all the different oil producing facilities, not even have to travel very far between Guyana and Venezuela. two neighbors. You got one country that theoretically could lose a couple 100,000, maybe 300, and another country that's going to make it. So even regionally speaking, and with Guyana being able to produce a relatively similar barrel. So does it really matter? I think more so in the, I guess, geopolitical risk forum, which over the past, I'd say 7 years, the correct move, and not to say that this is going to be true going forward, geopolitical news is let it rally and sell it like your life depends on it. None of those rallies have seemed to really stick around. Clearly, 2022 being a different animal, and that geopolitical risk, the kickoff of the Russia-Ukraine war, was in some ways maybe like we are today, a confusion of who's going to make it and where's it going to go, meaning a shifting of the global flow of crude. You know, we have enough of it, regardless of what happens with Venezuela. And I think, unless you got some more on that topic, maybe let's shift back to a more micro North American story.
Yeah, well, I think that's really kind of the interesting connection with Venezuela is that the impact, say, Venezuela heavy grade fits into the U.S. refining slate. Also, we're having the simultaneous impact of Canada tariffs and Mexico tariffs, and Mexico is having its ongoing production issues. So I think that this North American crude flow question gets a little bit more interesting. And considering the long-term question for Venezuela, world's largest proven reserves of oil, big question about what that's going to do for long-term development for Venezuela. I think, don't really have an answer for that yet, but it seems to be that the indirect effects of pulling that special license could be pretty meaningful in the long term for Venezuela's ability to develop its resources and bring those to the global market. But
I guess the only asterisk I'll put on pulling that special license long term equals, 3 years and 330 days, because who knows what the next administration chooses to do.
Right.
And for that matter, if there becomes, some economic benefit, because when you look at the Trump administration and all the efforts taken, it seems to be squarely centered on making America great again financially. Everything from, I'm not going to get too close to this hot button issue of the USAID, I guess, inquiries, but, it's really just trying to be more economically sound. And so I guess my point is, even within this administration, could there be a change of tune on what they expect in terms of a relationship with Venezuela? So,
just a point of leverage too in all these negotiations over unrelated items like deportations and broader trade. So I think with that, looking at Canada, this has been an interesting one to watch because Canada obviously plays a pretty big role in certain regional refining markets for the U.S. You want to kind of cover what you're seeing and maybe what we should be.
To me, the most interesting thing with the tariffs on Canada are what we've seen, which you've highlighted lately in terms of refinery runs. The general theme for the U.S. to start the new year is refinery runs have been very strong, particularly as we get into what is typically turnaround season. You look at a chart of refinery runs, and maybe we'll throw this in the show notes, but the break year over year, once we've got into February, is material. And where is that coming from? It's actually a thesis that we proposed back, I think, a little over a month ago, well, maybe even 2 months ago, when we first started hearing rumors of the tariffs on Canada and Mexico. I was like, well, it should be a product issue in the upper Midwest. And lo and behold, the primary driver of the overall strength in U.S. refinery runs is PADD 2, or the upper Midwest refiners that are cranking out a heck of a lot more product than they typically would this time of year, which makes sense. If you're about to have to pay more for your input, you want to produce as much as you can before that gets implemented.
Yeah, those refinery numbers have been pretty impressive for PADD 2, just for listeners' context. This week, we had capacity utilization in the Midwest about 93.5%, and it's been at or above the 5-year seasonal max for about 7 of the first 8 weeks to start the year. And those crude runs, as you mentioned, 75% of PADD 2 crude inputs come from Canada, and 100% of imports come from Canada. And so that's kind of, the question that maybe people understand on a broad level, but it seems like maybe we can give a little bit more context of what are the other options for the Midwest. And, I think the answer is pretty clear. There's not really a good alternative to Canadian crude for the Midwest. You can't.
Context complete. No option. Yeah.
Yeah.
I mean, it's just nothing's going to be efficient. You can troll the Twitterverse, or I guess the Xverse, and it's fun listening to all the people that are very frustrated with the all things green energy. I had somebody send me one this week with, I guess, a resident of somewhere in the Mountain West with a picture of a unit train full of PRB coal heading west. And, the storyline is, so we're going to put a bunch of coal on a train, burn a bunch of diesel to send it to a port, to burn even more diesel to send it to China, to run in a power plant, to make a solar panel, to put on a boat, to burn a bunch more diesel, to bring it back here, to make more efficient green energy. And so in some ways, the whole Canadian story is like, okay, great tariff, but even if they could get it from somewhere else, and there's a limitation on rail traffic, certainly if you're trucking it, it's very inefficient. Pipeline capacity. It's going to be really expensive, and you're going to burn a lot more BTUs than you would take in the nearest source of supply. I mean, you built the refineries there, and you developed the production infrastructure for a reason. It was efficient. It was proximate. Like, it's close by. We can turn it into the stuff that people need: diesel and gasoline, some jet fuel. And any other source is just going to be inefficient. And who pays the cost of that inefficiency? It's not the Trump administration. It's the consumer in the end. Or, there's still a hotly debated topic of whether it's the producer in Canada that has to bear the brunt. And, I guess in some ways, that's maybe the most interesting unknown. Fast forward 4 months from now, did these refineries that have been running so hard dial back to burn less of this more expensive crude? Are the producers carrying more of the burden, Canadian producers carrying more of the burden? And does that create some interest from, I'll call it the large independents or the majors, US based, to go in and snap up distressed Canadian assets? An asset's not distressed in weeks and really even months. I say 4 months. That's not even enough time. I mean, they're going to have to stick around for quite some, period before there is a problem that the market must address through divestitures, acquisitions. And then the point you made earlier about leverage, I think we've already seen that. The tariffs were going to be implemented on February 1, or I don't know, something like that, close to February 1.
Beginning of
February 3rd. I guess that's Monday. And then they weren't, using this carrot, this stick, or whatever you want to call it, to try to influence a path forward. Like Venezuela, these can be delayed again. They can be for a short period. I think everything is on the table right now. And to expect that they're implemented and it is, this is it. Rest of the Trump administration, there are tariffs on Canada and Mexico. I would not put chips behind that bet.
Yeah. And I think it is important to recognize the economic landscape in Canada, and their ability to withstand a prolonged trade war with the U.S. is minimal. Teetering on the edge of recession for the last few quarters. You have a lot of underlying cues that are a little bit concerning for the Canadian economy in particular. So I think you even had one of their finance officials coming out this week saying we don't have any capacity to withstand a trade war with the U.S. And I think that's pretty clear. For Mexico, I think the interesting question beyond the tariffs is this, and it's kind of this topic we've discussed in different arenas over the last year, 2 years or so, but you have the Dos Bocas refinery starting up. That was kind of this indicator of, okay, we're going to probably see less Maya crude available for U.S. refiners. But you're also having pretty significant issues with their production declines, which the latest data from Pemex in January showed that their crude and condensate production averaged about 1.6 million barrels per day, which is minus 12% year over year. Even more impressive was the export numbers. So their exports dropped 44% down to 530,000 barrels per day. Exports to the U.S. dropped 36% down to 321,000 barrels per day. So those are multi-decade lows. And I think that production issue is a big question for Mexico, especially as they're planning to start up the Dos Bocas refinery and potentially pull even more. So without Mexico, a big source of crude for the Gulf Coast and other regions, what else should people be thinking about in your eyes?
Well, on all things Mexico, I don't know. That was a big question. You just threw out some really interesting facts, and then you just said, what should people be thinking about? Give me some direction here, boss.
Well, I think the production decline, Dos Bocas, and tariffs, you have kind of three different scenarios that are seemingly bearish for crude supplies from Mexico to the U.S. The alternatives, maybe it really just comes back to, okay, what's OPEC doing? But I think there's maybe some disconnected threads. And I'm curious if you have any thoughts that bring those together.
I've got a harebrained theory. I mentioned earlier, what if production assets in Canada were distressed because it was the producers that ended up bearing the brunt of the tariffs? You've just covered really well the issues in Mexico, which Claudia Sheinbaum has, already come out and made a lot of public statements about trying to wrangle in the fragmented, struggling energy sector in Mexico. And while she has made clear there is not a door open to having direct ownership, operatorship in Mexico, she is certainly positioning the Mexican energy sector to receive foreign investment. Makes me wonder a little bit about the non-North American or non-Western hemispheric players with deep enough pockets coming in to invest in Canada or Mexico in the energy sector. First people that come to mind are the Saudis and the UAE. UAE has had, in recent years, more interest in investing around the world, but Saudi Aramco, why not? The mutual reliance, right? Okay, Canada can't withstand a trade war with the US. Well, the upper Midwest can't withstand, cut off of crude flows. There's a long list of, trade topics between the U.S. and Mexico that create some problems. We need their crude. They need our product. And certainly until Dos Bocas is truly up and running, I think the foreign investment, and that's where the waters get really muddy. Where's that money come from? If China were to step in, then, all hell breaks loose because we're trying to take a pretty strongly anti-China stance. I don't know. I don't think there is clarity right now.
Yeah.
And so every little headline will just create the next round of confusion for the time being. I don't think there's any new information that comes out in the next 6 weeks to 6 months that's going to have people go, I got it. I see where we're going now. Yeah. And I use that 6 week to 6 month time frame, purposefully, because I think at this moment in time, the expectation is that there will be an extension of OPEC curtailments and maybe as much as a couple quarters, 6 months, 6 weeks. We'll have some information. Actually, that was not true, and it is flowing. So, what happens with both OPEC flows and OPEC investment in potentially places around the world so I think going to put a wrinkle in whatever people expect is coming next.
Yeah. Final thing, what you were just mentioning brought up one of the interesting points that might be worth considering is the pipeline infrastructure from Canada to the U.S. and really this potential trade war. I think raises a lot of questions for Canadian producers. How are we going to get this crude out? Right now, you have the 890,000 barrels per day Trans Mountain capacity after the expansion was completed in May of 2024. That's not enough to, really offset any of the impact of tariffs, and provides no real alternative to getting this other crude out. There's a lot of interest in building a new pipeline, but, then you look at Canada's regulatory environment, and I think a lot of the Canadian players that could do that pipeline are pretty hesitant to even go down that path because of the multi-year studies that they have to do for communities and emissions and all the other regulatory hurdles that Canada's government adds in. And then this week you have, President Trump raising the question again about this Keystone XL pipeline, and, potentially see a scenario where there's a agreement for maybe some more investment on energy infrastructure from Canada through the U.S. Do you have any take on that likelihood?
Oh, admittedly, no. I'm gonna pass on that one. Not prepared and or have too many rabbit holes to go down on that topic for just this podcast.
Yeah, right on. All right. Well, then let's jump into the OPEC side, because I think that's maybe a good place for us to kind of round up the crude changes this week. We have a few different angles. One, we have Iran maximum pressure campaign 2.0. You have Treasury Secretary Scott Bessent telling interviewers in the middle of February that the administration wants to cut Iranian exports to 100,000 barrels per day, which is basically less than 10% of current flows, and most of that is going to China. So we have Iran. Then you have, the broader Saudi question, the production cuts that we'll get more information on for April. And then finally, you have the Iraq Kurdistan pipeline exports to Turkey, which commentary from the Iraqi and KRG government officials says, hey, we're going to bring this on as soon as the end of this week. Then you have the Association of Petroleum Industry of Kurdistan, so kind of the international producer group that manages over 60% of Kurdish production. They say, yeah, we're not actually going to restart exports to Turkey anytime soon. With all those kind of disparate threads, I think the question is, okay, what happens to Iraqi production? Their goal is to get up to 6 million barrels per day by 2028. A lot of investment interest in a new pipeline there. You have Iran losing flows, and then you have this massive spare capacity that could offset all of our all of the lost supply from Venezuela, Canada, Iran, and that's even before considering, the other North American production that we talked about. So where can we kind of tie these different themes together within the OPEC realm?
Well, I would work backwards through these. There's something kind of interesting to me, and a little bit off topic, but on the Iraqi Kurdish dispute, which is, not new since this pipeline was, essentially taken offline in 2023. The, battle between the Kurds and the Iraqi government is, I don't know, hundreds of years. I mean, we're talking a very long time. So will this conflict remain? Yes. But the thing to me is really interesting is when you bring up this, I guess I'll call it the API of Kurdistan, the foreign investment, right? These are a lot of global majors that have, dollars parked, efforts taken to grow production in that part of the world, some large, some small. Actually, that's not all the big guys. And then in the same general neighborhood, you've got Kazakhstan, who's, I think this is an interesting tie back to where we started with Venezuela. Makes you kind of wonder, did Chevron see this one coming? Chevron being one of the key players in the Tengiz field, and the recent record-setting production from Kazakhstan is okay, cool. You're going to kick me out of Venezuela? I'll go over here. So I think that just brings up the point of foreign investment. Propose the, I guess maybe for now, harebrained theory that somebody from the Middle East would come invest in Canada or Mexico to wield some influence on the U.S., kind of taking a page out of our playbook. We've done that, I guess, since inception as a country on borrowed dollars in the beginning. But, we try to, swing our big financial stick everywhere. We're the biggest buyer. We have the most dollars, which means we'll print the most, and we will not care to, what's about our debt. But do you see like more of this move to, and global majors investing in this part of the world? If there's this fragmented OPEC that seems to be, showing more cracks by the day,
Yeah.
you see more foreign investment in Kurdistan, in Kazakhstan. I don't think we're going to talk about gas at all today, but I think Azerbaijan's an interesting one with their gas reserves and European needs for gas. I imagine there is a little bit of a stalemate. Kind of work back through your points. Does it restart in the next several months? Probably. Everybody needs it. The Kurds need it. The Iraqi government could use it. If you got a plan to get to 6 million, that's another couple million from where we are in the next 3 to 4 years. I mean, this is part of that
start
puzzle.
now.
Yeah. You need to, everything needs to be flowing.
Yeah.
And before we got on today, I think in the end, we just kind of come back to the same conclusion. One thing we were talking about before we started was, it feels like Groundhog Day, just waiting for the next OPEC headline, which means what does Saudi want to do? And then that just is like this big picture. Like, do we have this triumvirate of global oil influence now squarely in place with MBS, Putin, and Trump? What say those three, I think in some ways determines where we go.
Yeah. It's almost 35 million barrels between those three right there. So
a third of global supply.
Yeah. Big movement. Yeah. And just a quick one on the foreign investment. Interesting point this week, even I think reaffirms what you're talking about. You have BP kind of going through their restructuring, reprioritization of their kind of investment dollars, but they're coming together with the Iraqi government and came out this week and said, hey, we're going to increase our investment in Iraq and start to bring the northern fields back online. I think there's about 3 billion barrels of proven resources that they're going to go after there. So where is that going to go? And I think that there's maybe this slow moving tailwind to just say, okay, we got to get this back online. So maybe you have some initial friction to overcome, but ultimately I think Iraq and Kurdistan really want to get that access to the Mediterranean and onto Europe secured, because Suez Canal is opening up. Any advantage of having direct access to Europe is starting to dwindle, and that advantage I think is an interesting one to bring up, because as you mentioned, that pipeline shut off in March 2023, and that left Iraq without access to the Med, and have really only left Saudi Arabia as the only major Middle Eastern producer with the ability to bypass the Red Sea conflict with Yemen's Houthis. And so everybody else was left hanging, having to go around the Cape of Good Hope if they wanted to access the Atlantic. So I think it ended up costing Iraq about $19 billion over the last 2 years. Not minimal, but definitely an interesting one to watch. I'm sure there's just going to be a ton of conflicting information continuing to come out. Do you have anything that you want to?
Man, I think one other thing, not on our set list for this week's concert, I think maybe next week it would be really interesting to take a little bit of a dive into India's refining build out. Cover that in a daily report this week. I think that is quite possibly at the core of where oil markets are really headed directionally in the next 3 to 5 years. You've seen that shift, it's a well-beaten path now, how China is no longer the dominant force in global oil demand growth, and the baton is being passed to India. There's quite the substantial refining build out. And, just in the past year, you've seen some big supply deals announced with Russia. There was permission asked to buy some Venezuelan crude when they got put back on the naughty list. So I think the Indian demand, and you've done some fine work on just what such a, and this is not a derogatory statement in any way, the, kind of third worldy, I say that loosely, somebody don't be mad at me. Yeah, developing world. How a country with such a significant population with access to freer flowing energy, whether that be gasoline, diesel, power, certainly in the context of this discussion today, more the first two, what that means for global energy markets. When you look at anybody's forecast, there's this other Asia or India bucket that is carrying a lot of the burden of global demand growth. And, I guess maybe like an interesting one to cover would be, who is other Asia? Because in a lot of cases, it's these smaller Southeast Asian countries where China has essentially gone in and bought the whole country up.
Yeah.
So is it just, it's like, in some ways, Venezuelan oil is Russian oil. And so too is Southeast Asian oil demand is really China's oil demand. We just put a different sticker on the side of it.
Yeah. I mean, on the really high level macro view, it's the same concept as, the US or Europe exporting its manufacturing to Asia, to bypass a lot of the regulatory issues that are really coming down on China specifically. China is then diversified to Vietnam, to Indonesia, and kind of anecdotal evidence. We have some kind of leads inside of those countries for the manufacturing side, and all the commentary that we get from them is just the massive build out of Chinese infrastructure over the last half decade, really kind of, as you said, turning it into, a derivative of China. And I think to cement that India kind of demand growth point that you're making, one of the really interesting ways to look at this for me is on per capita oil demand. And when you look at, major players like, say, the US per capita oil consumption is about 21 barrels per capita per year. Canada is 22. Then you look at the Asia region, South Korea is really the only one that has close to the US. You have just under 20 barrels per capita. You look at India, you have 1.4 on their way to 1.45 billion people. Their per capita oil consumption is 1.4 barrels per capita per year. China, was starting out at a similar place in the mid 1990s. They're up to 4.3, and they're now the second largest oil consumer in the world. So the scale that you can get with a country of that size, especially when they're developing infrastructure, they're creating just tons of roads. What does that do on a per capita basis? Because you only go from, say, 1.4 to 2. But on 1.4 billion people, that's a pretty sizable increase in national crude demand. So I think that really kind of gets to the point of that's a potentially underappreciated source. Just how long does it take is my question.
Yeah, I think it'll be a fun topic to maybe go into some more detail on, and the weeks ahead.
Yeah, absolutely.
My tongue-in-cheek comments always towards the end. Well, not throughout, but certainly towards the end of the day. I would like to see. I think it would be really funny. I mean, literally funny, to see the public outrage if Mexico said, "You know what? You can tariff all you want. We're going to tariff all you Americans that love to come stay down here in our Riviera Maya hotels. We're going to tax you staying here." What kind of outrage do we get?
Yeah, it would be unfortunate, but also, it's hard to imagine a scenario where Mexico or Canada can really sustain any.
No influence, no.
Yeah. Well, sweet. Well, I think we can leave it there, kind of a crude-focused topic this week, and we'll bounce back with, as you mentioned, some more interesting topics next Friday.
All right. Good being with you, Alex. Right. See you next week.
See ya. Thanks for joining us at The Energy Desk. Again, this is a limited series, so if you want to hear more episodes, you'll have to let us know by hitting follow wherever you get your podcasts, or by sending me a message at amelvin@mobiusriskgroup.com. See you soon. And please keep in mind, this commentary contains our views and opinions and is based on information from sources we believe are reliable. This commentary is for informational purposes, should not be considered investment advice, and is not intended as an offer or solicitation with respect to the purchase and sale of commodity interests, or to serve as the basis for one to decide to execute derivatives or other transactions. This commentary is not considered promotional material.